The global financial system can go from chill to chaos in one heartbeat, and this week that shockwave came straight out of Tokyo. One tiny comment from the Bank of Japan's governor Kazuo Ueda was enough to shake the entire world market like someone yanked the tablecloth. Japanese bond yields spiked within seconds, traders in Europe and the United States started panicking, and what looked like a normal, boring weekday turned into a giant flashing warning sign for investors everywhere. All Ueda said was that the bank would review the pros and cons of raising rates at its December meeting, super soft language, nothing dramatic, but for a country that kept rates glued near zero for literally decades, that tiny hint hit like a thunderclap. Japan has been the odd one out for years, while the United States and Europe kept hiking rates, so even a whiff of a shift instantly blew up assumptions people have held forever. The reaction was insane. 2-year Japanese bonds ripped past 1% for the first time since 2008, 10-year yields shot toward the 1.8 to 1.9 zone, and traders scrambled to rewrite their whole outlook on Japan in real time. And once that happened, the chain reaction went global. Bond markets in Europe snapped higher, then United States Treasuries jumped the most in a month, with the 10-year sliding back over 4% and the 2-year climbing to 3.5%. Suddenly, those dreams of 6 or 7 rate cuts in 2026 evaporated, and futures started pricing in just a couple maybe. Because when Japanese yields rise, investors everywhere start comparing returns, shifting money around, and questioning where they want their capital parked, which is why the United States felt the hit immediately. Japan has been one of the biggest buyers of United States Treasuries for decades, basically helping America finance its gigantic deficits, and when yields rise at home, Japanese investors have every reason to bring their cash back. That's a nightmare scenario for Washington because the United States is pumping out debt like crazy and needs foreign buyers to keep borrowing costs sane. So the minute Japan signals, hey, we might raise rates, demand for United States bonds gets shaky, which pushes yields up even more and slams the dollar. And we saw that instantly. The yen surged almost 1%. The dollar had its worst week in 4 months. Manufacturing numbers in the United States came in weak again, and investors started asking if the economy is losing steam. The euro and British pound picked up momentum while the dollar slipped, showing big money shifting out of the United States as uncertainty grew. Stocks felt it next. Tech names fell fast, the Nasdaq and S&P 500 dipped, and Bitcoin tanked 7% in a day, dropping more than 20% this month. That move freaked out traders because Bitcoin usually ignores the rest of the market, but lately it's been moving in lockstep with high-risk tech stocks, meaning when investors bail on one, they bail on both. Volatility spiked everywhere, and suddenly all eyes turned to the Federal Reserve. Markets still expect an almost guaranteed quarter-point cut in December, and that's been the only thing calming nerves. But nobody agrees on what happens after that, especially with rumors flying about who might replace Jerome Powell. A change in Fed leadership could flip the entire rate outlook, and combining that with Japan's potential pivot means the world might be heading into a totally new interest rate landscape in early 2026.